sell shares of publicly listed or traded companies. So generally, the stock market has to do with people need money who have excess money. So Warren Buffett actually put it, market is a device transferring money from a person to a patient person. So those who are in quote, or who are looking to sell, and the who are willing to buy and hold of a particular company. What are stocks? A stock is basically publicly traded company. It should be a publicly traded company of a company. So you can look at it pie chart, a pizza, where we have slice in there. Usually have a such that we have 8. So just picture it as one slide. Another person also takes another person to also take slide. Okay, so the more stock you own, the greater your claim of ownership on the company. A brief. You could see clearly the red slide of the pie chart. We come to the orange, the yellow, the green, and then the smallest being the blue. So the more money to buy the stock, or the more stocks you own in a particular company, show how your ownership of the company looks like. So the slide we have here, the red one basically of the or basically individuals holding bits and pieces in terms of slice of this very entity company. Now, there are types of stocks. Mainly, we do have the common stocks, and we also have the preferred stocks. The common stocks are mostly what we see on our stock exchange. We don't usually have a lot of quite in the preferred stocks on our exchange. We do have one that should be standard chart, SCB, that's standard chart. We have two parts. We have one which is a common stock, and we have one which is also a preferred stock. So generally, there are two types. We have the common stock, which is mostly what we have on our market or on our exchange. And the common stock basically refers to dividend to the fact that dividends are not guaranteed. What it means is the company in a particular year could make a lot of profit, but could decide any shareholder. And it's as simple as that. And that would be it. You will not get anything. However, the preferred stocks are such that year on year, they receive dividends. So generally, the two types, the common ones or the common stocks, don't usually have a guaranteed dividend. However, the preferred ones do have guaranteed dividends. Now, what do we look at? Or basically, our next slide refers to the fact that we like to look at how to read anything we see, especially that pertains to the stock market. What, I mean, the symbols mean, so we could have a bit of understanding as to what they mean and how we could actually understand them and how we could take steps to get involved. Any exchange, the various companies that are listed on exchange have a code name, which is referred to as the ticker, or so for instance, securities that are traded on a stock exchange have ticker symbol. So it's basically a symbol. Usually we will not have the full name of the company, printed out there. No, the company is quite coded to an extent. So the moment you see it, you know that, oh, this symbol refers to this particular company. So for instance, and the ticker is AGA. So anytime you see any data on that refers to the stock market in Ghana, when you see AGA, it just refers to a particular company, which is Anglo Gold Ashanti. We also have the Scancom PLC, UNIL. So generally, if you pick any data on any exchange, the things you would look out for, and which will give you a better understanding of what you are looking at. Number one is the ticker we just mentioned, and the ticker is simply companies that are listed on that very exchange. So for instance, this is just a snapshot of some data on the Ghana Stock Exchange. This data was pulled as of today, that's 31st of March 20. We have the daily date, the dates have been quoted there. And we have the share code. I just mentioned that the ticker is more like a code or a code for the companies that are listed on any exchange. So for instance, we have Access. Access there refers to Access Bank. We have ADB. ADB there refers to ADB Bank. BO, that's Benzo Oil Palm Plantation. We have quite a number of them. Generally, the code refers to a particular company. So to start studying anything on the market, it's advisable that you pay attention to how the companies are coded, or in quote, the tickers of the various companies that are listed. Back the performance of that company in any data you tend to find. We have the second side, or the second column, showing us year high. Basically, the year high refers to of the year to date, the highest price that ever reached. So for instance, the first one has to do with Access. It means that from year beginning, which is from 1st of January to date, the highest price the Access Bank shares ever won. That's a year high. So the highest price that very company or that very stock has ever reached. Then we have year low. The year low refers to the lowest price that stock has ever dipped to. So in this case, we are dealing with the first ticker, which is Access. The year low we have here is 4, which means that's the lowest price this very stock has ever plunged to. Now we have the previous closing price, which means that the previous day, the price that this very stock closed, and that we have it as 4. Now we have the opening price. So basically, the opening price tells you the price at which this very stock opened for a particular day. So we go on and on and on and on, and you'd actually see that we have this stock, and we're able to read what is really happening to that very stock day on day. So if you have this kind of data every day, you're able to tell how a particular stock is performing day on judgment. Not a detailed one, but just a glance, you're able to see how stocks are basically performing. Now, there are two main types of markets. We have the primary and we have the secondary market. What are the primary markets? The primary market basically is where a new security, which has not been ever traded on any exchange, is being listed. So, or is being issued. So, for instance, we recently, okay, let me pinpoint, because it was the most widely of the most widely stock during the IPO. So what it means to go public or Ghana Stock Exchange, we saw quite a number of people visiting people. Basically, this is a primary market stage where a company tries to its stocks to individuals, institutions, on and on and on. So basically, you can refer to this market as where stocks are created. The company has never been listed. They have chosen to now begin to issue stocks to the public. So at this stage, we say that this is where the stocks are being created, the first stage of a company trying to get listed. So that's a primary market. So at this primary market, people come to you, they speak to you, we are selling these stocks at so and so and so and so, then they get people to buy in. And when people buy in, they put the data together, and then they say that the issue was successful or not successful. Basically, the primary market is where the stocks are created, and then from there, we move to the other stage, secondary market. This is where existing shares are traded. What it means is previously issued stocks. So once the stock moves from the primary market area, it now moves to getting or being listed on the secondary market. And on the secondary market, anybody can buy any stock once it's on the secondary market. So for instance, the moment we move from the primary market, we are on the secondary market. And on the secondary market, as we have it now, the Ghana Stock Exchange, anytime you want to buy, anytime you want to sell, you'd have to move to the market and you'll be able to pick your shares from the market. And basically, that's how the secondary market also operates. I wouldn't go into details. I'll wait when I'm done. I'll call for questions, and then I think the explanations through the answers and question portion, I think will basically explain into details what I mean by these various slides. So this slide basically breaks it down into the primary and then the secondary. So number one, we have it as the issuer. That's on the green side of the slide. We have the issuer now trying to sell shares. So they issue the shares, and investors, you can see them in green, they buy into it, and then they hold the shares. That's the first stage. After the stage, which is the primary market, it moves to the secondary market. And on the secondary market, it's no longer the company issuing shares. It's now people who have already bought the shares, selling, and people who either have or don't have at all, trying to buy from them. So you could see that existing shares are traded among investors. Either an investor initially bought during the primary market or not. Once it's on the secondary market, they can always come on board to buy holdings of a company on any market as and when they feel the conditions are perfect for them. So I mentioned earlier on that in issuing the stock, when a company is trying to issue a stock for the very first time, they go through the process of issuing it through the primary market. And the primary market is basically also goes through a process which is called the initial public offer. Of this is embedded in what we refer to as the primary market. So the initial public offer, that's the first time the company is going to issue its shares to the public. And we refer to this, as rightly indicated, the process of offering shares of a private corporation to the public in a new stock issuance for the first time. That's the first time. So we call it the initial public offer. So when you hear IPO, they are basically referring to the very first time a company is going to issue its shares or offer its shares to the general public. In our case, the market or the exchange we do have now is referred to, or basically the Ghana Stock Exchange. Like I mentioned earlier on, narrows mostly to what we have in Ghana. However, I'll touch briefly on what the global market basically looks like. Now we have the indices. So basically a collection of stocks representative of the stock market. So the indices basically is more like a collection of all the list. I showed you a slide much earlier on. Let me go back. This one basically tells you the stocks that are listed on exchange, and on a day-to-day basis, an indices is calculated, which shows the performance of all the stocks that are listed in an exchange, or in our case, on the Ghana Stock Exchange daily. So we see where the market is moving, whether the overall market is doing well or the overall market isn't doing well. Basically, that refers to the performance of the index, or the indices of a market, of an exchange. Now, if someone asks me, so how do you make money in the market? The stock market basically could be looked at from this point of view. In every country, or across the globe, let me refer to across the globe, we have seasons. When you look at the European side, they have 4 seasons. In Africa, we do have 2 seasons. So basically, we have seasons where things tend to change over and over again. Basically, when you look at the stock market, there are seasons. We can refer to these seasons in a cycle. And these seasons are such that things tend to go up, they drop, they go up, they drop. And all of this put together makes up an investment cycle. So you realize that there are times when cost of goods, maybe a particular product, will go up, will drop, go up, slam, up, and slam. Basically, that's how the stock market performs, or that's the movement of the stock market. Prices of listed equities go up, they drop, they go up, they drop. How do you make money in these instances? One would have to basically look at when to actually go in to buy and when to sell. Your entry and your exit is very key. If you don't pay attention to your exit, you don't pay attention to your entry, you might not make the money you anticipate to make. So basically, the stock market, how do you make money? You buy low and then you sell high. If the thing is cheap, buy it. When it goes up and you feel it's gone up enough where you've made some money or where you've made some gains, you can go ahead and sell at that level. That's one way to make money on the stock market. The second way of making money on the stock market is through dividends. It's through dividends. And the dividend isn't assured, it's not guaranteed. A company can choose to pay dividend or not choose to pay dividend. You can't do anything about that. If they choose to pay dividend, you go with the flow. If they choose not to pay dividend, you go with the flow. But generally, what I'm trying to pinpoint is that the dividends are more like added bonuses. If they come, that's fine. If they don't come, you concentrate on your ability to be able to buy low and then sell high. So basically, these are the 2 ways of making money. If you are able to make gains on the price of your stock, that's fine. If the dividend also gets paid because the company declared dividends, that's also an added bonus to you. Prices to change. There are so many varied reasons why stock prices could change. Listed in this slide, number 1, supply. There are quite a number of times when there is demand and there isn't supply. The economists will tell you when there is demand and there's no supply, prices tend to go up. And that's the same model that applies to what we have on the stock market. One will ask, what if there's no demand and there's a lot of supply? It just means that the prices are likely to plunge. So change, go up and supply. Second has to do with expectations. When you hear earnings, please, it just refers to profit. So people expect a particular company to make so much profit, and this very context to be able to make a profit where it's able to hit. You could see the prices of the stock go up brings a lot of confidence onto the market, which basically would translate into the movement of the stock prices. The prices will tend to go up. However, when a company makes it clear, or makes an announcement that they expect this quarter, and they end up falling short at the end of the quarter, it just means that the company isn't thing that happens to a company that they do have shares in. So if you don't meet their expectations or the earnings target, as you mentioned, you realize that your stock prices will start going down. Also have an attitude to certain companies. So what latest information, they react to that very, very examples as then we move to economic. Generally, every stock, the indicators, leading indicators. Generally, when the leading indicators tend to be forward-looking. They look at what they project to happen in the next few months. When they look at the economy and project and we begin to tell their very point. The months go by. And when you look at advance, the main whether they should buy a particular stock or not to buy it, and indicators will know when exactly together. Basically, the largest volumes of a particular. So I was basically in the next few months or even years. So generally, anything basically referring to information. Information is very key when it comes to the stock market. One should always be fishing for information when it comes to dealing with stock markets. If you don't have information, you might be late to the party. So if you want, or if you want to really start trading or start doing anything on any stock market, you have to start fishing for information. Because without information, you'll be lost. And by the time you realize and decide to make any move, you'll be late to the party. Then we move to why invest in stocks. I indicated here that return on investments in the market are 3 to 4 times, but in actual fact, they are way, way more than that. They are way, way, way more than that. People could make hundreds of percentage gains on their investments when they invest on the stock market. You can't really put a limit to that. I can buy a stock today at 1 Ghana cedi. Before the year runs out, this very stock which I bought at 1 Ghana cedi would have hit 30 cedis. It's not 3 or 4 times. It's way, way, way more than what I've even indicated here. So generally, the stock market has very good so much money or so much gains when he or she invests on the stock market. The other side, one could also lose so much money wide range. Unlike the fixed income market where you have an idea of what you are earning and all that. But the stock market isn't like that. You to lose so What are your goals financially? If you're able to answer these few questions, then you will be able to tell or know whether the stock market is a place for you. What is your risk tolerance? The explanation I've just given now just indicates that it just means that the risk component associated with investment in the stock market is on the high side. And this basically means that return rises with risk. When you are making so much money, the same way you could also lose so much money. So what is your risk tolerance? Number 3, do you want to actively manage portfolio? You can buy a stock, hold it, or go to sleep. After 10 years, you come back. The stock you bought at 1 cedi would have now dropped to 50 pesos. And you'll be angry. I bought this. I invested my money for 10 years. I can't come back to have my money reduced by 50%. No, that's not how the stock market operates. If one wants to invest on the stock market, you've got to be vigilant. You've got to watch what really happens on the stock market. So, for instance, I buy something at 1 cedi and I go and sleep for 10 years. Within this 10-year period, the price of that stock I bought would have moved up peaked where the stock was going up and dropping at the same time. 1 year, I bought a stock at 1 cedi, it goes to 2 cedis. It goes to 4 cedis, 5 cedis. Then it drops back by the close of the year to 2 cedis. If you go to sleep after buying a stock, you bought it at 1 cedi, but this same stock went to 5 cedis. You never sold to realize your gain. So you lost out on that opportunity. This same stock would have dropped from 5 cedis to 2 cedis. You were not aware of what was really happening on the market. So you never took advantage of that opportunity. This same stock could go as high as 30 cedis. Because you don't monitor, you don't follow what has been happening on the stock market, you will not be able to take advantage of this stock when it went to 30 cedis. So the question again comes to us. Do you want to actively manage your own portfolio? If you do, then there's a need for you to actively monitor what happens on the stock market. If not for anything at all, consider it as an investment which you have a keen interest. You have actually deposited your money there, and you should have an interest in what happens to that very stock every day, every week, every month, every year. Keep monitoring it. If you do monitor, you'll be able to make money from your stock on the exchange. If you choose not to monitor, There are experts like us, which is Echo Capital, who are able to do this monitoring for you. We will buy, we do the monitoring for you. When it's the right time to sell, we will prompt you that there's a need to sell. When it's the right time to buy more, we will prompt you this is the right time to buy more. So we could come in, or we would come in to help you manage your portfolio. However, if you want to manage on your own, there's always the need to do a lot of monitoring. One other thing we would also want to touch is for you to learn how to diversify. If you're investing on a stock exchange, don't put all your eggs in one basket. Don't say, I'm buying only MTN shares. I'm buying only GCB shares. I'm buying only Total Ghana shares. There's always a need to diversify. Spread it to at least 8 different stocks on the market. With that, when one is losing money, or when one of the stock is dropping such that you are making losses, there are other ones that would have cushioned you in your portfolio. So the reason for which we always propose that one or investors diversify when it comes to their investments is to ensure that should something be going wrong with one or with any of the investments in the assets or in the portfolio, you have the others to cushion you. So don't put all your eggs in one basket. A moment, please. So the question comes again, where do I start? Number one, let's start by being able to read the table. That would have at least whipped up our interest as to whether we would like to invest on the stock market or not. These things, as you go through them, your interest gets whipped up. And I believe that's one of the ways to really start building an interest in stocks. At this juncture, we'd like to stop here. And we'll say I'm ready for any questions you might have. If I've not really explained anything the way you expected it, you could also put it across, and then we'll delve deep so that we would all be able to understand and come to a better conclusion. Thank you very much.
Thank you very much, Elliot. I believe that this has been a very insightful journey from the beginning of the slide to the end of the slide. Like Elliot mentioned previously, if we all have questions that we need to put across, I believe some of the terms used in this context were a bit foreign to many of us. So if you happen to hear any of the terms used and you want further explanation on it, I believe there's a point you ask your questions. I've also received a couple of questions from our WhatsApp platform. Perhaps we can start with those ones. Then if anyone has any other question, I would require that you put your hand up so that we can call you. Or if you don't want us to hear your voice, perhaps you are driving or something, or you are busy for which reason you are not able to hear your voice. I mean, you can send the chat. Okay, send the chat to us or send a message through the chat platform so that we can read it here. And then we get Elliot to address those questions. Okay, so I think I'll go with the first question that came through WhatsApp. It says that how easy is one able to buy stocks, and how many do you need to make a profit? How many do you need to buy to make a profit? Let me take it again. How easy is one able to buy stocks, and how many do you need to buy to make a profit? Elliot.
Thanks so much. Let me start this way. One wouldn't need so much money to be able to invest on the stock market. With 100 cedis, 50 cedis, it depends on how much that very stock you are looking at would cost. So let's say with 100 cedis, you're able to buy a number of shares of a particular company, assuming that the particular company we are looking at has its share price quoted as 1 Ghana cedis. With an amount of 100 Ghana cedis, you could buy about 100 shares of that particular company. When the price of this stock moves from 1 Ghana cedis to 1.1 Ghana cedis, that means 1 Ghana cedi 10 pesos. Yes, yeah, that should be 1 Ghana cedi 10 pesos. When this stock price moved from 1 Ghana cedi to 1.1 Ghana cedi, that would have mean that you would have made 10 pesos on every share you bought. So that 10 pesos multiplied by the number of shares you have actually bought. So in this case, you bought 100 shares. You multiply that 10 pesos by the 100 shares you have, and that gives you 10 Ghana cedis on the 100 Ghana cedi you invested on or in that very equity. So the same way, we could also explain it the same way for the loss in the value or in the price of that very stock. You bought it you paid 100 Ghana cedi for it, you got 100 shares, you bought it at 1 Ghana cedi. When this stock price drops to the value of your investment is going to that the price, which is the 90 pesos at which the stock now costs, would be multiplied by the number of shares we are looking at. In this case, 90 pesos times the 100 shares you have, and that gives us 90 cedis. This will mean that you've lost 10 pesos on the stocks you bought. So I believe this breakdown should do for our listener who's actually asked the question. However, if it's not clear, you could come again and then I'll do a further explanation. Thank you.
Okay, thank you, Elliot. I believe there's a message in our chat box. We have here from Mr. Daniel Mati, and he says that, please, I know we have stock markets and capital markets. So which one is better? I know we have stock markets and capital markets. So which one? I believe he wants to find out which one is more profitable. A clear understanding of what the stock market is and what the capital market is will even give you a good guidance as to what answer it should be. So Elliot, if you can kindly touch on this for us. I know we have stock market and capital markets. So which one is better?
Okay. So if you are, I believe the question rightly is trying to look for the comparison between what's on the fixed income market and then the stock market. I think that's what I believe the person is trying to find out.
Okay.
Right. Yeah. So the fixed income market is where we do have the treasury bills, the cocoa bills. Now the stock market is even looking at listing commercial papers also there, where we have the bonds, both corporate and sovereign bonds and all that. The fixed income market generally gives you an idea based on the rates or the yields we have there as in what one will be able to earn for a particular period of time. However, on the stock market, you are unable to determine what gains you are going to be making and what losses you are going to be making. So for the fixed income market, one is able to tell, oh, this is what I'm expecting. This is what I'll be earning within this period. If it's 6 months, if it's 3 months, if it's 1 year, this is what I would be able to earn. So you're able to really project when it comes to the fixed income market. However, on the stock market, it's not that easy. You are not able to tell whether a particular stock will be able to rise to hit a particular price limit. So that's the clear distinction. However, the potential of the stock market is many a time way outweighs what's on the fixed income market. Like I mentioned, you could buy something at 1 cedi. At the end of, within a short period, this 1 cedi stock you bought could rise to 5 cedis, 10 cedis. And when you look at it, let's say it rose from 1 cedi to even 5 cedis. That's like you've made like over 500% gain on your investment. However, when it comes to a fixed income market, we don't have any yield as in 500%, 200%, and all that. Even the most recent one we've had was hovering around, the treasury bill was hovering around 35 and all that. But we can't really go and start expecting returns of 100% and all that when it comes to the fixed income market. No. It's really not that huge. However, the opportunity with the stock market really gives you a wider range in terms of the limit to the gains you are able to make. Thank you.
Thank you very much. Listening guests, we are very privileged to have Dr. Hilado also listening to this program. I think his hand is up. So Dr. Ado, I want to give you the opportunity to ask a question, please.
Thank you very much. I am very proud of you guys, and I'm honored to be at your meeting for the first time. And that goes to my question. When you listen to CNN and other international media, organizations, there is something called the Wall Street. Okay. My question is, when will Ghana have the Wall Street situation? And is it Eco Capital that is taking us there, or some other investment management company? Thank you very much.
Thank you very much, Doc. We are very grateful to have this question put across this platform. Elliot, can you touch on the question for us?
Doc, thanks so much for the question. The Ghanaian market, or the Ghana Stock Exchange, is still a developing exchange. Like I mentioned earlier on, the presentation mainly limits us to what we have locally. However, we following the developments the market is really going through, we expect that our market would over the period reach or get to a very significant level in terms of development, where a number of things we see on the developed exchanges would now begin to happen in our market. So, for instance, on the developed markets, whenever a stock price goes up, one is able to make money. When a stock price goes down, one is also able to make money. But on our local market, you can only make money when the stock price goes up. So it's one of the things we are looking at our market developing to be able to get to, so that it wouldn't just be a long market, but it would also be a short market. What I'm trying to say is that it wouldn't only be a market where people only make money when the stock prices go up. We should also be able to make money when the stock prices also go down. And that's what the developed markets are really enjoying us at now. And it's just a matter of time. We believe that our stock market will get there, but it's a gradual process. Thank you very much.
Thank you, Mr. Amponsah. We have a couple of questions coming in. We have one from Engineer Aki.
Sorry.
Yes, sir. Yes, sir.
Sorry. I asked two questions.
Okay.
I asked two questions. My second question is that, is it Echo Capital that is taking us to this Wall Street scenario or some other company? Thank you.
Okay, sir. Elliot?
So thank you very much, Dr. Hiller. The stock exchange, or the Ghana Stock Exchange, is a company on its own. And as it stands now, that's the only exchange we have in the country. And they have already taken the lead and are already putting measures to take us there. Echo Capital only happens to be a player on the market. Okay. We are not mandated to operate like the way the exchange operates, or we don't have the license to operate as an exchange. So as it stands now, there's only one stock exchange we have in Ghana. However, we can have more than one, but as it stands now, there's only one we all play on. So our mandate doesn't take us to being able to basically play the role the Ghana Stock Exchange is supposed to be playing. Thank you very much, Doc.
Thank you, Mr. Amponsah. Doc, I hope it's well explained, sir.
Yes, I get it now, but I'm happy at what you guys are doing. Maybe the Ghana Stock Exchange would wake up from what you are doing. Thank you.
Thank you for the
Thank you very much.
Thank you very much, sir. Okay, so we have Engineer Ake, who also sent a message to our chat box. It says, kindly inform me, how do I buy or sell stocks as an individual? Do I need an intermediary person or a company to do that for me? Thanks. Elliot.
Okay, thanks so much, Engineer. If you listen to me carefully, I mentioned that if one is willing to, or is ready, or decides to participate on activities on the exchange, he or she should be willing to dedicate time to monitor what happens on the exchange. Participating on the exchange isn't difficult at all. There are institutions who have been licensed to be the leads when it comes to participating on the Ghana Stock Exchange. A number of institutions have taken licenses or have received licenses from the Securities and Exchange Commission. And these institutions, in this case, we refer to them as the brokers, the stock brokers, or generally the brokers or the dealers. They are the institutions who are mandated to buy stocks for people and sell stocks for people. You yourself can't just get up and go directly to the stock exchange to do anything. You can only do anything or carry out any activity on the stock exchange only if you go through the stock brokers or the dealers. So in this instance, I wouldn't want to mention there are so many brokers we have. What you need to do is to just go to any of the brokerage houses to set up an account. You want to buy stocks and sell stocks, or you generally want to trade stocks. They will give you some forms to fill. To the broker. Go ahead, I've deposited 200 cedis. Go ahead and buy me 10 shares of company C. The broker, because they have seen your money in your account, will go ahead and buy those stocks for you. There is an account that is being created And this account is called a CSE. You buy will be held in for you. So it's not like when you buy the shares, you don't know where the shares are being kept. No. There's a special account created to hold all your shares. So the narration I just gave, when the broker buys all these shares for you, the shares will now show or reflect in your CSE account or statement. You can request that they give you your CSE account or CSE statement, and you see that the shares have been bought for you, and the details will be specified on the statement as and when you request for it, and as and when they also furnish you with that. But then, or basically having said that, it just means that you would have the responsibility of monitoring everything that happens to the shares you have bought, because if you don't do so, you would have yourself to blame after some period of time. Monitoring it gives you an idea whether what you have bought is doing well or isn't doing well. If it's doing well and you are happy with where it is going, you can choose to buy more. If it's not doing well and you feel that you are not happy with what's happening, if you are patient, you can relax and wait for whatever stock you bought to make a U-turn. And like I mentioned, the market is such that there is always ups and downs. There is always ups and downs. Stocks go up and they fall. They go up and they fall. No stock goes up and stays there forever. They will by all means come down to an extent. So that cycle of up and down would still continue. So if you are going onto the market to buy stocks for yourself, you have to monitor and keep watching the performance of those stocks you have bought every day, so that you have an idea what is happening to your money on the stock exchange. Thank you very much. However, let me just chip in briefly. You could also come to a fund management company like Echo Capital. We would use your mandate, generally your authority, to set up the account for you and buy those stocks for you. And with that, we have a responsibility of monitoring the performance of the stock for you, so that you take off your head the stress of having to do the monitoring yourself. Thank you very much.
Thank you very much, Elliot. We are having a number of questions coming in, and I can see a number of hands raised to ask their question. However, I would want to do this, on the basis of early bird. We have also one distinguished personality to join us in this conversation, in the person of Mr. Newton Dertutu. Mr. Dertutu sent a question. Let me read this. It says, considering the challenges we are faced with in the country now, is it advisable to invest on the capital market, on the fixed income market, or in mutual funds? Elliot, I believe you would like to take this question.
Okay. Thank you very much, Mr. Dertutu. Yes, so the current economic challenges we are facing now, I'll pick it firstly from the mutual fund side. There was a big deviation in terms of the yields or interest rates on the market. So it tends to affect the mutual funds we do have in the country, or that are being managed by fund managers across the country. However, there is being, there is being, or we are beginning to see some correction of the interest rates or the yields on the market. So the brouhaha with the mutual funds is beginning to settle down. So one could choose to invest in a mutual fund as it stands now, because to an extent, or largely, the abnormality we had with the interest rates on the market have corrected. So one could invest in a mutual fund. With a mutual fund, we have experts who manage them and are able to pick very good assets into the fund to give some very good yields or returns to the investors. So mutual funds are okay. The fixed income market, as of now, like I mentioned, has seen a drop or a correction in terms of the rates. So over the past few months, over the past few weeks, the interest rates, which was hovering around 35, 34 and all that, has dropped significantly to where it is now. Treasury bill now is hovering around, I think the last time I checked was around 18, 19, thereabout. And all. So from 35, there's been a huge drop in the fixed income market. That's one. So it's okay if one feels that I want to invest in the fixed income market. That's fine. That's fine. It depends on the kind of confidence you have in the economy. However, investing on the stock market, or basically there is always an inverse movement with what happens on the stock market and what happens on the fixed income market. When interest rates tend to go up on the fixed income market, you have a lot of investors trying to sell off their shares to go and participate on the fixed income market. They want to go and take a chunk or enjoy the high interest rates on the fixed income market. And that's what has happened over the past few months. People were selling their stocks, no matter how they sell it, even if it's cheap, they'll go ahead and sell it because they know that when they sell, they can easily come onto the fixed income market and get 35%. So that's what has been happening over the past few weeks. However, because the fixed income market has dropped its rates, people are no longer interested there. They are now beginning to move back onto the stock market. So usually, when the stock market is really doing well, we tend to have the fixed income market not doing well. And when the fixed income market is doing well, the stock market isn't really doing well. So there is almost every time that inverse relationship between the stock market and then the fixed income market. However, referring to the question, considering challenges we are facing in this country, I would advise, like I mentioned, there's always a need to diversify. Have something in mutual funds. Have something in fixed income market. Have something in the equity market or the stock market. With all of this, if one isn't going well, I believe the other will do well so that it will cushion you in terms of your assets in your portfolio. Thank you very much. I just hope the question is rightly answered. But if it's not, I'm always available to continue explaining it better further. Thank you.
Thank you very much, Elliot. I think we lost one person. He needed to ask a question. I think Dr. Hilado, your hand was up at a point. I don't know if yes, Doctor, kindly talk to us.
Yes, I actually wanted to draw the attention of the presenter. The question that the engineer asked was about brokers. And I thought Echo Capital was one of them. So that should have been the first issue that should have come up, that Echo Capital would be one of the brokers to support the engineer. Okay.
Okay, sir, Doc. Thank you very much. Elliot, do you have anything to add to it?
Okay, Doc. I think I explained that at the finishing part of my response. I mentioned that yes, if you want to go directly, that's fine, but you have the responsibility of doing the monitoring of the performance of the stock yourself. However, you could also come to fund managers like Echo Capital, who have the expertise to lead or buy these stocks for you, monitor them for you, and prompt you as to when you should sell and when you should buy. So Echo Capital could also serve as an intermediary in getting some of the stocks or participating on the stock market. Thank you.
Sure. Thank you. In fact, that's where I dropped my hand.
Okay.
Because you mentioned that, that's why I dropped my hand. Thank you.
Okay, Doc. Thank you very much for commenting. We also had a hand raised up from the user, someone with the username Galaxy 812. Please, if you are still interested in asking a question, kindly go ahead, please. Yes, kindly ask your question, please. Okay, the hand is raised, but unfortunately we can't hear any question. Because of the want of time, we'd like to progress with other questions that we have coming through WhatsApp. This says that how can you predict that a stock price will rise or will fall? This says how can you predict that a stock price will rise or will fall? Elliot.
Okay. Thank you very much. During the presentation of the slides, we indicated that there are certain indicators that are used to predict whether a stock is likely to go up or a stock is likely to come down. There are quite a number of, there are economic indicators. I mentioned leading indicators, coincidental indicators, and lag indicators. That's one. We also have the financials of the company, the performance of the these companies or a particular company that's listed. We run our analysis of the company and we're able to project whether the company is likely to do well in the next few years or in the next few months and all that. So when you conduct analysis of a company using the tools I've mentioned, you realize that you would be able to tell whether this company is likely to really do well or not likely to do well. So with this, I think I believe I've explained it to the benefit of the one who really who asked the question.
Okay, thank you very much, Elliot.
Hello?
Yes. Yes, I think it's clear now. Can we move on to the next question, please? Okay, so this question says that we hear the stock market is very risky. What must motivate you to invest on the market? Elliot, can you take this?
Okay, so again, I go back to the slides where we mentioned that you would have to assess yourself. Are you the type who is willing to take risk with your money? There are quite a number of people who are not willing to take any risk with their money. Generally, the kind of risk the stock market exposes one to is higher than what we have on the fixed income market. So people who are not really open up to take the kind of risk the stock market opens them up to should not venture to invest on the stock market. However, if you are willing to take on that kind of risk, you could always hit the stock market. What we advise from our end is that people who, in quote, let's say the aged, people between the ages of 50, 55, going to retirement and all that, we don't usually advise they put a
Sorry about a slight technical challenge. You're trying to resolve this so that our presenter can get back on that.
Hello. Hello. I think I went off briefly because I had some internet challenges. I don't know whether you can hear me now, please.
Yes, we can hear you. We can hear you.
Okay. So the question I was trying to really answer had to do with whether a moment, please. Hello, Mr. George. Hello,
Yes.
Mr. Horatio. Yeah,
Yes,
could you
sir.
please help with the question again, please?
Okay, so the question states that we hear the stock market is very risky. What must motivate you to invest on the market?
Okay.
Yes, and
So
I
I
think
mentioned earlier on.
yes.
So I mentioned earlier on that there's always a need to diversify one's portfolio. If you have, let's say, 1,000 Ghana cedis, there's always a need to diversify, as I mentioned. If you are a young man, you could break this 1,000 Ghana cedis and create a portfolio out of this 1,000 Ghana cedis. You could, if you are young, 40 below, you could decide to use about 50% of this 1,000 to participate or to trade on the stock exchange. What it means is you can use 500 Ghana cedis, which is 50% of the total 1,000, to buy shares and sell shares on the stock market. You could use the other 500 to buy units in mutual funds or even buy some other fixed income assets. However, if you are within the bracket of the aged, we don't usually advise that you participate heavily on market. With a cash of about 1,000 Ghana cedis, if you are aged, if you are within the range of the aged and you still want to do anything on the stock market, we usually advise you use just about 10% of the 1,000, which is 100 Ghana cedis, to do any trade on the stock market. The other 90 should be invested in any other asset which is not exposed to a lot of risk, so that basically your overall 1,000 would have some minimum exposure compared to the younger person who is able to take on a lot of risk when it comes to the stock market. So the motivation generally, number one, should span from the fact that one could diversify. And when you diversify, the tendency of you making so much compared to what other fixed income markets will offer you should serve as motivation enough for one to invest on the stock market. Like I mentioned, there's always a need to diversify. So if you diversify, you could make money from elsewhere or lose money from another asset, and they could complement each other in cushioning you in terms of your financial stance. Thank you.
Thank you very much, Elliot. We have another question from the chat box. We have Dr. Hilado asking, how does Ghana Stock Exchange or Echo Capital create that critical mass for people to see investment as a way of living as in the US? Let me take the question again. It's quite a mouthful. It says, how does Ghana Stock Exchange or Echo Capital create that critical mass for people to see investment as a way of living as it is in the US? Elliot, can you take that?
So Echo Capital has a wide range of products which are on offer to the general public. We are human beings. We start work at some point in our lives. We work maximum 40, 50 years, and we are supposed to go on retirement. The energy with which you started work at a younger age wouldn't be the same energy you would have when you are old. So when you are old, you wouldn't be able to work any longer. I think the Bible even states that you wouldn't be able to work any longer when you are old. Whilst you are young, within your working life, there is always a need to invest in financial assets, either financial assets or physical assets, so that on a rainy day, when you are old and you are unable to work any longer, you could fall on these investments and live on these investments. And that's what, like Dr. rightly mentioned, the other economies tend to encourage their citizens to do. In Ghana, there are a wide range of products, which Echo Capital also has quite a number of them. There's always a need for one to set aside monies from whatever work you are doing, put them into investments. Investments are not savings. You invest in a product with a mindset or anticipating that the value of whatever you are investing your money in would appreciate or would go up. So if you are working every month, you set some money aside to invest, every month you invest, every month you invest. If you even do it for like 10 years, you would realize that you have really set aside some money, aside some money into investments, which is growing and working for you. Anytime you are unable to work again, you could always fall on these investments, which will serve as a cushion for you. So there's a need for us to cultivate the habit of investing. There are several products we have on our market. The stock market is just one. Mutual funds, there are fixed income products and assets we have on the market. There's always need for one to invest in financial assets. Aside financial assets, there are other tangible assets one could also invest in, but there is a need for one to invest. Thank you.
Thank you very much, Elliot. I believe we'll take our last question, and then we will tend to draw the curtain down on today's edition. This question was also sent on the WhatsApp platform. It says that at what age can you buy a stock or invest in shares? At what, I don't know whether we have a legal age for anyone to indulge in investment. So I think this participant wants to find out, at what age would you advise that we buy a stock or invest in shares? Elliot, can you take this one?
Okay, so if you're looking at the legal age, you should be 18 to be able to do anything on the stock market. If you are less than 18, it's always advisable that somebody would hold the account in trust for you. So for instance, there are parents who are investing in various asset classes for their kids. So what it means is parent A, Mr. Amponsah, has 4 kids, has decided to set up investment account for all his kids. So he creates the accounts as Mr. Amponsah in trust for son A, Mr. Amponsah in trust for daughter B. And that's how accounts are created. And these investments are done into those accounts for the kids. Their dad, who is Mr. Amponsah, only holds that for them. The other side of the question has to do with at what age should I be investing in stocks? Once, you see, the age really isn't much of a problem. But once you're able to prove to yourself that I can take on risk, especially when it comes to the stock market, you can really go and start buying stocks if you are willing to take on the risk. You know, there are people who do is it the bets, the super bets and all that. They lose money and they take it cool and then they move on. That's basically how the stock market looks like. You can invest and you make money and you are happy. If you lose, you should be fine with it. So the younger generation or the younger folks, I believe, are able to absorb such losses with ease. However, there are some, in quote, who still are not willing to take on any risk. So once you are not willing to take on the risk the stock market gives to you, you don't go there. You just don't go there. Rather go into any other asset class you believe you are very much comfortable with. Thank you very much.
Thank you very much, Mr. Amponsah. Thank you very much, everybody. I believe this was the answer to the last question. We still remain open. Our doors are always open. If you have any questions, you can visit the chat box right now. We left our contact information for anyone who wants to ask questions pertaining to the stock market, pertaining to investment, mutual funds, the capital markets. A few of these names came up during the presentation, capital markets and the rest. I believe many of us are getting interested in investing. One thing we do at Echo Capital is that we want our clients or our prospects or those who interact with to be very educated and to be very informative concerning the happenings in the investment world. And that is why we regularly have some of these programs so that you are well equipped with the information you need before you invest. And I always tell people that when you invest, you need to get a professional advice from an investment advisor. Don't go ahead and then you invest in instruments and vehicles that you are not familiar with before you realize your money is gone. I believe that this platform offers us this opportunity to understand the risk and the reward when it comes to investing. Thank you very much, our guest for today's show, that is Mr. Elliot Amponsah. For those who missed the introduction, Mr. Elliot Amponsah is the head of fund management or the portfolio manager for Echo Capital. He would be a regular on this this show. Hopefully, next month we'll have another edition where we would pick another topic and then we open up for discussion. Thank you very much. Thanks for all who have joined. Shall we have a short word of prayer before we depart from this platform? Our Heavenly Father, we are grateful for this opportunity to be alive in the land of the living. We ask, O Lord, even as we've understood what it takes to invest on the stock market, we pray that it shall not be only something we heard and we forgot about it, but we pray that even as we take investment decisions, we shall remember everything that has been discussed here and we'll be guided by those principles to invest wisely on the markets. We also pray that we need money to invest. If there's no money, there's no investment. So Father, Lord, we ask that you open the windows of heaven and bless us with more money. Let our businesses prosper. Let our work flourish so that we can generate enough income and revenue for us to even invest. Also, we pray for our customers, our clients. We ask that the peace of God shall be upon them I pray that you build traffic to Echo Capital. And I pray that you continue to make Echo Capital the one-stop shop for investment solutions. In the mighty name of Jesus, we've all prayed with thanksgiving. Amen.
Amen.
Thank you very much.
Amen.
Thank you very much.
Amen. Amen.
Thank you very much, everybody.
Amen.
Thank you very much.
Amen.
We hope to have another session of this.
When?
Unfortunately, many people do not take retirement planning very seriously. It is a task that we can not afford to compromise. So let's look at a few reasons why people retire from work. One, you retire from work because you reach the legal age of retirement. In Ghana, 60 years. Two, you could retire from work because you need to take care of a loved one. Three, you could retire from work because you felt it is time to retire and you just need to take care of yourself and have fun. So largely, these are the main three reasons why people retire from work. Therefore, it is important to sit down with retirement or financial planners to guide you through the process. There are a couple of factors that needed to be considered. One, how long do we expect you to live after retirement? What is your plan? Where are you going to be staying during your retirement? How much money do you need during your retirement? Will you still be paying school fees? Building new houses? Countries or places that you plan to visit? These are all factors that needed to be considered. So let's quickly look at 4 phases of retirement planning. First one is planning. When you plan towards your retirement, what you'll be doing, how you'll be living, where you'll be living, that all fits into the planning towards your retirement. The second one is adjusting. What you live, some of the best benefits that you're entitled to during your working days, you will not be entitled to those. So we need to adjust. Then the third phase is enjoying. As you've adjusted to your retirement, you now begin to enjoy your retirement. Then the final phase is you are now settling into your retirement. It is therefore very important that you seek expert advice. Consult financial advisors, investment planners, like Echo Capital Investment Management Limited. Help you through this process. So I come your way again. My name is Delap. Thanks for watching.
Echo Capital. We empower you to stand.
If you were to stop working, imagine this to yourself. How long can you survive on your remaining savings? What I just asked you was the definition of wealth. Here is a man named Robert Kiyosaki, an American investor, businessman, author, motivational speaker, and financial commentator who became well known in the recent years, who has an estimated net worth of $80 million. Want to know something interesting? He wasn't raised in a wealthy background. In fact, his family was like most people who worked, but didn't have the best financial education and oftentimes struggled with money. So then, how did Robert become rich today? Let's take a look as he explains in one of his bestsellers called Rich Dad, Poor Dad. Robert Kiyosaki was born in Hilo, Hawaii in April 1947. In 1957, at age 9 years old, little Robert was attending the same public school where the rich people sent their children, for his town had lots of doctors, business owners, and bankers. Robert saw that the rich kids would separate themselves from him, where his family wasn't able to afford the newest collections of toys and bikes like them. So, one day, Robert asked his father, who had a PhD and completed multiple universities with excellent degrees, "Dad, can you tell me how to get rich?" Unfortunately, his dad didn't know the right answer because he wasn't rich himself, so he responded with, "Well, use your head, son. Stay in school, get good grades, so you can find a safe and secure job." His real dad is what he'll be referred as poor dad. He wasn't poor during this time. In fact, he was making lots of money. But in the end, this man's financial life takes a turn for the worse. Now, little Robert has a friend named Mike, in which Mike's father would be referred as Rich Dad, who started mentoring Robert and his son Mike about how to really become rich. At this point in time, Rich Dad wasn't really rich yet, but soon became to be one of the wealthiest men in Hawaii. So then, what did Rich Dad teach Robert? Rich Dad poured a strong financial foundation into these kids' minds of many important principles. To start off, the first lesson you need to know is you must know the difference between an asset and a liability, and that you need to buy assets. If you want to be rich, this is all you really need to know and understand the most. You see, the rich acquire assets, and the poor and middle class acquire liabilities. But sometimes they think they are assets. The primary cause of financial struggle is simply not knowing the difference between an asset and a liability. Right. You don't even know what an asset and a liability is, don't you? An asset is something that puts money in my pocket. A liability is something that takes money out of my pocket. For instance, let's draw a cash flow pattern of a normal individual. This person right here earns his income from a job, and his expenses are things like food, clothes, entertainment, and transportation. Unfortunately, he doesn't have assets, but sure does have liabilities that constantly takes money out of his pocket, because things like mortgages, taxes, credit cards, loans, and believe it or not, the house. Now let's take a look how the cash flow pattern really works for the rich. Instead of looking to earn more money from their job as the only source of income, they buy and own assets that brings money into their pockets as a form of passive income. Passive income is something that earns money that doesn't require you to trade your time for it. So in other words, you would be earning money even as you're sleeping. Examples of assets are businesses that doesn't require your presence, stocks, bonds, mutual funds, income generating real estate, royalties, notes, and anything else that has value that produces income. As mentioned before, poor dad was making quite a lot of money from his job, but his expenses seemed to always keep up with his income, never allowing him to invest in assets. As a result, his liabilities, such as his mortgages and credit card debts, greater over time. And this is the fault of having income equals expense and assets is less than liabilities. And sadly, this is what drove poor dad into debt even after he passed away. On the other hand, Rich Dad's personal financial statement reflects the result of a life dedicated to investing and minimizing liabilities. So he has income that is greater than expense because of assets is greater than liabilities. This is practically why the rich are getting richer. Their assets generate more than enough income to cover expenses, with the balance reinvested into the asset column. The asset column continues to grow, and therefore the income grows with it. You see, both dads worked hard, but they have opposing attitudes and thoughts. One dad recommended study hard so you can find a good company to work for. The other recommended study hard so you can find a good job to buy. One dad said, "The reason I'm not rich is because I have kids." The other said, "The reason I must be rich is because I have you kids." One said, "When it comes to money, play it safe and don't take risk." The other said, Learn to manage your risk. One said, I can't afford that. The other said, how can I afford that? Although both men had tremendous respect for education and learning, they disagreed in what they thought was important to learn. Robert learned from Rich Dad that the truth about the general population, their lives are run forever by two emotions, fear and greed, that keeps them stuck in a pattern of get up, go to work, pay bills, get up, go to work, and pay bills. Fear has them in this trap of working, earning money, working, earning money, and hoping fear will go away of not having to. Instead of confronting the fear, they react emotionally instead of using their heads. The other emotion, which is desire, some call it greed, is a second reason why people also work. They desire money for the joy that they think it can buy, but the joy that the money brings is often short-lived and soon needs more money for more joy, more pleasure, more comfort, and more security. You see, that same fear and desire is what makes a lot of people be so fanatical about school for a better chance of a high-paying job. But don't be discouraged. An education and a job are important, but it won't exactly handle that fear. To handle that fear, you need to learn the power of money, not be afraid of it. Unfortunately, most schools don't teach about this, and if you don't learn it, you'll become a slave to money. Ignorance of money can cause so much greed and so much fear that can lead you into life's biggest trap of constantly working.